Hello, everyone. Happy Friday. Hope you guys all had a really good trading week today. We are super excited to get the Q&A started. We have some of our traders here today. We got Taylor, David, and Kody here to do our Q&A. So we're going to have an open mic, pass that around, and hopefully get your guys' questions answered. So if you guys have any questions or want to start it off, feel free to raise your hand and we can pass you the mic. And I don't see any hands being raised, but we do have some questions from social media that we could start off with. So the first question is going to be, what is the best futures options contract to day trade for a small account?
David, you can take that one.
Yeah, gosh, there's a lot to unpack in that question because it is a pretty limited question, right? So futures options and day trading and small account, right? So look, I will say a lot of times day trading can be tough in a small account, especially for a newer trader, right? A lot of times it is a lot easier to swing trade. Day trading, man, you got to be right each day. Now, when it comes to futures options, Kody actually, and it would be good to get his mic going because his recent class was basically doing just what that question is talking about. It is a day trade strategy using futures options, right, to sell a far out of the money premium. Now, the interesting thing about that when it comes to answering this question is. And I'm putting words in Kody's mouth here, but where I think he came to that strategy from was not starting off saying, I want to day trade futures. It was sitting there saying, hey, look, I want to sell very far out of the money spreads and I want to do it in a small account. How can I do that? And there's some advantages to futures options in doing that in the ES versus the SPX because the margin requirements are a lot lower when you do that with spreads and when you do that right in the futures options as opposed to doing it with the SPX. So what I'll say more generally, if you really want to focus on all of those things, futures options, day trading, and small account, is you got to start with what your strategy is first because there are going to be downsides to several things, right? So there are options in the micro S&P futures, right? So the MES, but they are extremely illiquid. So if you're doing very short-term day trading, it's really not going to be the greatest idea because you're going to lose a lot of money in the spread. So I might be tempted to use the MES options, the micro S&P futures options for longer-term swing trades where that spread is less, or the illiquidity is less of an issue. I certainly wouldn't do that for day trading. And so the ES futures options are perhaps more suitable for day trading, but those can get expensive depending on what your strategy is. So this is all going to come down to less about just, hey, day trading futures options and small account. It's really going to be what strategies are you trading, because there are option strategies that work great in the S&P futures. Some of them are going to cost more money than a small account can handle, and you're going to need something smaller like SPY futures or micro ES futures. So without talking more about why to do each of those things, it's tough. But I would definitely say if your strategy can be done in a small account with the ES, then your account can handle the risk, do it with the ES futures. Otherwise, I think you probably have to relax one of those other requirements, either a longer term swing trade in the micro ES or looking at something that isn't in the futures option, something in the spiders or something like that.
Awesome. We appreciate that in-depth answer, David. Kody, did you have anything to say about that yourself?
Yeah, so when it pertains to the way I've been trading them, the ES futures and that day trading manner, as far as which is the best options contract. Just like David said, I prefer the ES futures over the micro simply due to liquidity. And I've been trading for a small account the ES futures options, building that synthetic short position, and it's only been taking up about $1,600 of margin for the position. But to get down to the question, or to answer the question, it is simply the ES futures due to liquidity, and you could do that with a small account. If you're in it, like David said, it's strategy dependent. But if it's a question referring to what's recently kind of been talked about, ES features is the way to go versus micros. And the only reason I started doing the ES features is simply to get around the PDT rule, so you can lock up your profit quickly without having to get smacked with the PDT penalty. But that's pretty much it. David pretty much nailed it all on the head. There's really nothing else to say about it.
Awesome. That definitely answers that one. And just a reminder, if anyone does have a question, it is going to be open mic. So if you would like to request in the bottom left corner to speak, you can come on, ask your question to the trader you would like to speak to. And so if we don't have anything, I do have another question in a second. So I'll give it a second if anyone wants to give their request. All right. I'm still not seeing anyone. So T, one question that we do have that came in for you. How has your big three indicators helped you in this current market environment, such as this week?
Yeah, that's a great question, man. I think the most helpful thing about that indicator in this market is, like, the best example I have would be like the energy sector, because obviously we're in a market where, Monday, Tuesday, Wednesday, the setup might look really solid, and then come Thursday, Friday, things can get a little bit messy. So, like, for example, we got into XLE earlier in the week, based on a handful of big three buy signals. A lot of those started to disappear yesterday, and then by this morning they were all gone. So as far as like a pain-free risk management decision, those buy signals will get us into good-looking trades. But more importantly, as soon as those buy signals disappear, we pretty much hit the road before things become a bigger problem. So that's where it's been really helpful, especially this week with all the whipsaw action.
Awesome. And it looks like we have our first request. So Damon, I'm going to get you in here so you can ask that question. You should be able to speak now.
Hey guys, can you hear me okay?
Yes, sir.
Awesome. Very cool. My first open mic. Absolutely love Simpler. I've been with you guys for about 2 years. And Bruce would probably be the one to answer this, but how much do the Greeks and IV go into your decision making prior to the charts? Obviously we're looking at ATR, we're looking at moving averages, but given all the meme stocks, the 200, 300% IV, are you guys ever putting on a trade specifically for the Greeks, selling a super high theta, or selling a Vega for that insane IV?
Yeah, so I'll tell you from my perspective, there are sort of certain times and certain strategies that are very Greek dependent. I don't do them very often, but here's what I would say. As as a trader, if you're looking for sort of a very deep structural understanding of how options move, right? Then the Greeks are going to help you with that. And that's where I use them, is just to get a general idea most of the time, right? And that's more about strategy than anything else, right? So if I'm looking to compare a couple of different strategies for a trade, I may look at it and say, well, I generally think volatility is going to go up or down. I think so how are my Vegas looking? How are my thetas looking? How fast am I going to get my theta decay if I put this trade on versus that trade on? Just sort of knowing my purpose for the trade. So that's kind of one way to do it. Just sort of know the various things that your strategy is dependent on, and then compare different strategies. If you do that, you get a handle for it pretty quickly, and it is a really good way of sort of building your ability to just sort of say, how do I choose which strikes or which this or which that, is to really be able to put two trades against each other and battle it out, right? This one, this one's a little better on theta. This one gives me more deltas. There are, when you start to think about things like gamma, right, which over the last couple of years, everyone's gotten really excited about gamma, just sort of tracking the gamma in the market. These guys like spot gamma and this and that. But it also can be a really useful Greek for choosing trades and managing trades, because a lot of times when you're long options, gamma is what you're looking for, right? You're looking for to get into a trade perhaps cheap, and then get and then as it starts to go in the direction that you think, right, your deltas keep increasing and increasing and increasing, right? That's what gamma measures, how much delta increases. So a lot of times when you get certain imbalances in the market, you can do things like ratio calendars and things like that, where you end up having really low risk, but you get a lot of gamma for free. And so, without getting sort of too deep in the weeds here on a Friday afternoon, those are the sorts of things that I look for the ability to spot on the chain and structure my trades around, just around the Greeks, is when I'm looking for ways that I can sort of get low risk gamma, if that makes sense. But those are pretty technical and theoretical trades.
Hey, I want to take a stab at that question. Here's something that hasn't been, I don't believe, really talked about much, but the way I look at it when it comes to the Greeks as far as picking a trade. So when it comes down to, if you think of it in simplest terms of debit spread versus credit spread, and what I want to do is I want to use Amazon as an example. Like it got down, well, it was down, but what, 3% earlier today, right? But now it's down only 2%. But say your setup is you think price is going to go back up, and we'll just say 130, right, for an example. Just a pure example, just throwing a price out there. You think price is going to go up to 130. So you're thinking, okay, you want to get bullish on price action. Now, how do you want to structure your trade? You're not wanting to do just a long call. So you're okay. So now you're thinking verticals. You could do now either a credit or debit spread. And something I have done in the past, so whenever I look at, well, I can say in the past I still do it. When I'm looking at getting directional, I will play or price out a debit spread and credit spread with the same strikes. Now, sometimes what I have found is sometimes you'll get a better risk reward on one end or the other if price is inflated in another direction. So if I was to use Amazon as an example with the huge gap down, the puts are going to be inflated. So you have a bullish bias. You think price is going to revert, we'll say over 2 weeks, just an example. And this is just an example. It could go either direction, but you think price is going to go higher. And if I'm targeting 130, we'll just say I'm looking at a 125, 130 bull call spread, right? Bull call spread, for whatever reason, is going to cost you $3 because they're not inflated in price. But there are times when if I would look at a 130, 125 bull put spread, because the puts are inflated, I will see that I'll get a much more credit, we'll say $3 of credit, meaning I'll only risk $2 to make $3. And all I'm wanting is the price to go the same direction. Like nothing's changed. I'm still targeting 130 or above. Still want it to go that way. But the difference is the amount of risk and amount of reward you'll get in it. So to really break it down is if options or the IV is inflated in one direction or the other, your outlook's still the same. But if you do a credit spread, in this example, you will get a better reward because you're being paid $3 while risking $2. But if you did a debit spread, you actually end up paying $3 just for $2 of reward. So there are times when I find that in the market, and that will help me dictate how I'm going to structure my trade. But that's, for me, that's when I use the Greeks to structure a trade.
That was definitely super helpful and certainly segues off of David's recommendation of kind of letting two trades battle it out. And I'll use Tesla as my example. I've gotten in the habit of doing a Monday morning butterfly, trying to get super theta positive. And this week's was a 5-wide 300 pin on the put side and a 5-wide 305 on the call side. Certainly watched them battle it out. And I ended up doing fairly nice, swinging the 300 put side today. It was something stupid. I got it for like a 26 debit and swung it for like $1.60, $1.70. But that is really where I'm blaming Dan Passarelli's book on this, because I'm certainly putting most of my energy towards finding super positive theta trades on those flies. And I guess my next question, I'm not trying to hog up all this time, directional butterflies, is that nails on a chalkboard, or do you guys employ that strategy a lot, if at all?
I do them all the time. I call them targeted butterflies. Um, and I'm not sure if Taylor or David have a thought on this, but for me personally, I did, like you just mentioned, Tesla. I actually had one on Tesla too. What was it, 10 days ago? I threw on a targeted butterfly, 10 wide, targeting 300. Got in for $1.40, and granted, I closed it early, but could have flipped it out easy for about what, $8. But nonetheless, I personally enjoy doing them. Um, but for me, the hardest part on them, I think, is timing, because you have to get time and price correct. But whenever the market was just trending higher, like in 2016 and 17, when it was kind of just bouncing up higher but slowly, instead of doing diagonals, I found it beneficial to do out of the money targeted butterflies, and just kind of the way I describe it is scoop the butterfly in my net and just catch it. So it offered a better risk reward. But that's my thought on them. I personally enjoy doing them as long as the setup is there.
Yeah, and I would say I love doing it as well, and just sort of building off what Kody was talking about earlier, just with those credit spreads and being willing to do right a credit or a debit depending on how the calls versus puts were priced. I mean, obviously, if you're doing it that way, you're cool doing sort of right in the money credits, which I don't think people do enough, and I love doing in the money credits. And I mentioned that with respect to the butterflies as well, because if you're doing directional butterflies, you can just do it as a pure vanilla butterfly, but you could also do something as an unbalanced butterfly to get to a destination or beyond. And when you do it that way, you're going to end up doing it as right an in the money unbalanced. As long as you're cool with the possibility of assignment and realize that you may need to come in and deal with that some mornings. I love that way of going about it, because a lot of times, whether it's with those butterflies or with the credit spreads, again, if they're out of the money, you can end up taking a significant amount of the width of the spread in as a credit. And if you have a strong idea of the trend, you can have very little risk because you're collecting so much credit that again, if you're right a decent amount of the time, it ends up being just a great strategy. So and that of course will give you a lot of that theta you're looking for, Damon.
I freaking love simpler trading. Thank you, David, and thank you, Kody.
No problem, man.
And Damon, to add on to your first question, we actually do have Bruce scheduled in 2 weeks to come into our free room and do an intro to the Greeks. So definitely look out on our social medias for that. And just a little heads up for you on that. If anyone else has any other questions, if you would like to present and ask the question, feel free to request, and I will get you in here. If not, then I do have more questions that I could run through by the traders. One question that I got for all the traders here, I guess, is do you guys have any open trades right now that you guys are currently holding? What are your intentions with those, and maybe what are you seeing with those trades, and how do you see them playing out? We can start off with T if you want to start, then we can go across the board to David and then Kody.
Yeah, I'll kick it off, man. I'm full bear right now. So we got rid of a few bullish trades today. We got rid of Tesla for like break even. We got out of EMPH for a small profit. So now all we're left with is an October expiration SPX call credit spread. And that's all the way up there at 4,100. So that's looking pretty good. And then on the break of 290 today, we started to nibble on some October QQQ puts. So my thinking for now, as far as those two trades, I think the bulls have got a lot of work ahead of them here. So with the break of the lows here today, I think that kind of opens up the door for a flush back down towards the June, July lows. So what I would want to see next week for the bulls to have a case here to try to rip it a little bit higher would be a pretty quick move back above, that 290 level of support, 390 for the S&Ps, and then I think they got to rip it higher from there. So in the event we plunge, we're all set to go, man.
Yeah, I'm right there with Taylor. I am I'm short and I'm short and I'm short. I've got some short ES futures that I've been in since since we started to drop on the CPI numbers on Tuesday. I've got some micro ES starter positions that I've had since August 18th, closer to that top. I was just waiting for that bounce that we've had since the start of last week. I was waiting for that bounce to come and then jump on it. And then the other thing that I've jumped on with options trades is I've got some put calendars. So I am short the October 21st 3,400 puts, and long the 3,400 puts for that November 18th expiration. So that, just getting back to the Greeks, that's a nice little delta negative trade and vega positive trade, meaning it's going to make me money the more price goes down, and it is going to make me money the more volatility goes up. And if we head down towards 3,400, I am guessing volatility will go up. So that's what I'm sitting on, and my intent is to hold them until we get down towards 3,400, or we see price action that starts to tell me that I'm wrong.
All right. So, yeah, I got a lot of positions. As far as swinging goes, I am loaded bearish. If subscribers that are on here right now know I've been showing to quote unquote trade like a hedge fund, which means you have your directional bias and you're still a hedge fund with a longer bias. But anyways, to answer the question, I am short, and these positions are all October expiration. See, I have the SPX 3850, 3800 bull put spread. I am short Facebook's 155, 140 bear put spread. And I am short Amazon, a 125, 115 bear put spread. I'm short Cisco, 45, 40 bear put spread. And also short Procter & Gamble, a 135, 144 bear call spread. And then to the upside, I also have EMPH October 320, 350 bull call spread. And then I also have a bull put spread and a long call on DVN, which was flirting with my stop loss today, but Monday will be the tell if I'm going to cut it. And to go to Damien's question as well, when he was asking about targeted butterflies pretty much, or directional butterflies, I actually put one on today on SO, a 77, 80, 83 bear call spread. And that one was looking for upside as it came down into support, and with a beta of only 6 and moves slowly. And this one's only for September. So I am thinking with the large dark pool prints that happened on Tuesday and Wednesday, we got the large flush down. I do think we're going to come up and test the SPY's 389.95 level. And if we do get that rally over the next few days, I expect SO to go back up to its 80 level resistance with the butterfly, which will help hedge out my shorts. And then once the SPY hits 389, price should potentially, if my theory is correct, roll back over, and then I'll just roll those positions into other ones. So I am short 5 positions, long basically 2 and 1 sideways. So I have a lot. I doubt anyone ever got any of that, but that's pretty much what I'm looking at, or what I have.
Awesome. Thank you, guys. Looks like Samuel actually has a question, so I'm going to give you the mic here. I'm going to add you as a speaker. Connecting. You should be good to go.
Hey, guys. Can you hear me?
Yes, we can.
Good.
Okay. Hey, thanks, guys. Thank you for this Q&A. It's great. I've always loved what you guys have been doing. I've been with you guys for a few years now. I was with you in the rooms for quite a long time, but I've been out for a little bit now. I do a lot of traveling for a living, so I'm in and out quite a bit. I don't know if we have access to Allison. I know Allison's a listener, but I don't know if you guys can answer this or if Allison can answer it directly. But I know she's been doing some of the end of day SPX butterflies. Trying to figure out what she is trying to look for the target. Is the expected move, or how she's getting the center strike?
Give her the mic. Give her the mic. Give her the mic.
Putting Allison on the spot.
Yeah, I didn't know if I was on today for Twitter Spaces, so I was just enjoying and listening in. I do apologize now. I am taking the kids somewhere, so I'm in the car while driving if I cut out. But I actually did a class on this not too long ago. But basically, so, obviously that goes into a lot more detail. But in short, I have found usually the sweet spot for me to jump into an end of day pin trade is around 220-ish. So I do really try and wait till market close before I put on anything. And I have found the reason that time specifically is one, right? You don't have much time for the market to move against you at that point, right? So it can't just randomly pop down and then pop back up. Though certainly in this volatility, I guess it can. But usually there's not as much time for the trade to go against you. And I found out 220 specifically for whatever reason is sometimes it looks like things are going one way, like towards the end of 1 o'clock going into 2 o'clock. But for whatever reason, right around 220, sometimes it can completely fake out and go the opposite way. And so that's why I specifically try and wait for that time of day, because for whatever reason, I just noticed that 220 can kind of cut out some of those fake out moves and give you a better opportunity to jump into the right side of the trade. But from there, in short, it's very much like day trading, right? So you want your indicators to be in agreement. I usually like multiple time frames to be in agreement, which is why I have a grid pattern up. So, if the 5 and the 10 and the hourly all look good in the same direction, that makes it much easier. And then from there, it's all about playing one level into the next. So I'm not necessarily trying to aim for the perfect pin every time. And there have been times where I've gotten that pin. There have been times where the trade has blown past that pin. And that's why I like to do factor. Sometimes, they get to the pin and then they drop back off and it made more of a day trade opportunity. But it's really about just finding where you think it's going to set up as it's going into the close and then playing into that next level, whether it's a price level, maybe it's a technical level, maybe it's the max pain for the day, right? But playing into that range. And then, if you are able to day trade or you want to use one of your day trades, then certainly doing that. Today, for example, I had one in the mastery and we started to go in that way. It allowed 2 times today for a day trade opportunity to get it. But then unfortunately, right, it could make it all the way to the pin and then we bounced up into the close, which is why, like I said, the day trading has the better win rate versus the cash settlement. But certainly the final thing I guess I look at, which I wouldn't say is the last thing I look at, but it's all about that risk tolerance, right? So when I let them cash settle, they have to be within a proper risk versus reward scenario. That's how, even to today, right, all my cash settled trades have won out my losing trades, and I'm still net ahead on the strategy for the year because I am so strong about staying within my risk tolerance. So I usually try not to go above $1.50 risk if it's like a 10-point plus spread. And usually the only times I've gone a little bit over that is when I've already taken winners. So I hope that kind of helps answer it in short for you.
Yes, it does. Thank you. I'm actually I do a lot of SPX put credit spreads at the end of the day. A lot of times I'll look at certain levels, like today, for instance, and I usually let them cash settle. I was looking for some reason, I'm looking at different levels. I was looking at 38.80 to be a closing above. So I did a put credit spread with a 38.80, 38.75. And it almost got up to it. It was up to 38.77, I think, at one point. And it was just so close. And I could have taken a little bit of a profit at that point for the day trade, but it just didn't. I didn't have time. It just turned around so fast because it was so volatile. The SPX is so volatile, and I ended up taking a full loss. But it was a fairly. I mean, it wasn't too bad. It was a 2-for-1. It was 100 and I think it was 170 potential loss with a potential 330 gain, and I ended up taking the full loss, obviously, because it dropped down to 73, I think, at the very last minute. But so I was just kind of trying to figure out if there's I think the butterflies would probably help me a little bit better at the end of the day versus just doing the put credit spreads and letting them cash settle, which is what I usually do to keep away from the PDT. So I'm just trying to figure it out. But I think I'm going to probably try to jump on your course sometime soon to try to get a little bit more clarity on that as well. But thank you. That does answer my question. Thank you so much. Thank you, guys.
Of course. Yeah, come join us. And I was going to say, when it started to bounce, I too was looking to play to the upside. But the reason I didn't double up on a trade today, which I don't do very often, but every now and then if I jump in too early and it looks like it's reversing and everything's still within my risk tolerance, sometimes, I'll look to play the opposite way. But 38.75 is a mini psychological level. So sometimes that's where it will try and hang out at. But on top of that, for today specifically, we had a very hard time ever breaking above the highs. And because of that bear sentiment, even we're getting that profit taking into the close, or maybe people were setting up bullish for Monday or something like that, it was kind of pressed to break above that level due to the technicals there, as well as the fact that we've never broke above the open or the high of the day, really. So just to help you out for next time, things to look at.
Okay, great. Thank you so much. Yeah, I was noticing with the huge drop off from last night, the huge gap down, and then it started to push back up there, and the highest it got was right about that 38.80 mark. And I was thinking maybe because of quad witching and everything else going on, I thought maybe at the end of the day, they'd try to push it back up to right around that even point there, the 38.80. That's the only reason I did that as opposed to the 75. But I was really close to it. I mean, I could have taken a quick $50 hit, profit, but I ended up letting it go all the way because it was just so fast. Everything was moving so quickly.
Yeah, it certainly wasn't to the close. And it's certainly not a bad, place to put the strikes or anything. But that was the reason I saw into the close personally, why I was like, I'll just take the loser today instead of trying to work two losers, right?
Great. Thank you so much. And thank you guys for everything you guys do. I really appreciate it. I was Sam in the room with you guys for a long time, and I conversed with you quite a few times, Allison. I appreciate everything you guys do, and I will definitely try to get into your course fairly soon, I think, with that.
Of course. Yeah. Thanks so much for the question.
Thank you, guys.
Awesome. Thank you for the question. If anyone else has any other questions, feel free to request as well. Allison, thank you for jumping in there kind of on the whim. Do appreciate that. I have a question for you guys all personally as well. You guys mentioned having bearish positions on. Is there a line in the sand for you guys that you would maybe second guess your positions? And if so, what is that line in the sand?
For me, it's the weekly 21 EMA. Like I do expect a lot of back and forth. And like in any bear market, we're going to get some of our biggest, short squeeze rallies. But as far as like the bigger picture structure for me, the S&Ps and the Qs can start to close back above the weekly 21. Then I might have to shift my tune as far as, looking for a move right back down towards the June, July lows. So for me, that's kind of the line in the sand.
So I'm looking at 4083 in the S&P. That's from the Voodoo lines. That's the Voodoo fire line. And, we popped above that Monday to just give it up. And at this point, we shouldn't be back above there if we're really heading down. Now, below there, I'm looking at 39.17. And that is another Voodoo line level. It's a Voodoo snow line. It's the most significant level that we've been near on this side of the fire line. And we may go up and retest it, maybe get a little wick above it. But if we find support above there, again, the question was at what level would I start to question things? Yeah, I'd need to be a little bit cautious if we spent too much time building support above 39.17. So I wouldn't conclude that the idea is wrong there. I'd need to watch the patterns and the shape, but that is certainly, I think if we're heading down, we're probably just going to pick up speed and get going. Of course, we have the FOMC coming up next week, so we could get a little bit of wiggliness while we're waiting for that. But like I said, I think if we're going down, we're going to keep going down from nearby.
Okay, so where would I consider myself wrong? I have several levels and thought processes on it, but to really answer the question, if we get back above, on the SPY anyways, 389.95, which is where that's the most recent single day large dark pool print level there was 22.5 million shares that were late transacted there at 389.95. If we get back above that level and keep on creeping higher, basically, I guess really to answer that question, we get back above it, I'm going to start questioning myself, getting probably putting more bears on. But when I put on my full out, we'll say bull hat, is if we get above 410 to 412, between 410.75 and 412.07, there was a total of 48 million. Anything above 10 million is worth noting, but there's 3 days worth where it equates 48 million late prints between 410.75 and 412.07. If we get back above that level and then we push it back above the daily 200-day SMA, which is way up there, I will say I am wrong and flip bull, which is that move is quite far away, but I'm looking at longer term. So basically, first level 389.95, and then if we get above basically the 410, 412 area, I will flip bullish and just target the 200-day SMA until we get above that level, because we're right between or we're below those heavy levels. And the next level below us where we potentially could bounce is at 379.08, which is where there's 24 million late prints. So level to level, basically looking at it, but the floor 10 to floor 12 is my first big level of concern, and then slightly before that be 389.95, which is what we just broke yesterday. So yeah, I know that was really probably complicated, but that's what I'm looking for. Sorry if that didn't make sense.
So for me, it was the 100-period simple on the daily chart, but when I saw how heavy the bears were in the market, right? You kind of need that even mixture of bears and bulls for things to actually move. It made me cautious that we might get not like a big short squeeze, but a little pop above that to shake out some of the weaker hands or the tighter stops, if you will. Maybe, get some bulls in to even up the mix a bit more before it shorted back down, which is what ended up happening, last week into this week. So my stop is a little bit above that now, closer to the 30-period simple and the ATR trailing stop, as well as right around that range is also the 100-period simple on the weekly chart. So if we really start to break above that, then I might change my tune. But one of the things I've been thinking about this market since really since October of last year is that it just might be a really wide range of chop. So currently I'm a little bit more bearish just because we're below the 100-period simple, but I'm still very cautious about necessarily how much lower we're actually going to go, because from a monthly standpoint, to me, it's just be that this is just a very wide range of consolidation, while monthly technicals reset the next year or two before we try and continue higher maybe.
Awesome. I appreciate the answer from all you guys, and Allison for jumping in here and getting along with it. So we do have one last question, and we'll end it on that. Joseph's been patiently waiting, so I'm going to hand the mic to Joseph. He'll get his question, and then that will be it for today's spaces. So Joseph, you should be connecting right now. It looks like you are good to go with your question.
Hey guys, Toro Joe here. So I want to say I appreciate all you guys coming on. I'm also dropping kids off from school, so I apologize if I cut out. But my question just kind of comes to your process and letting the trade work. Lately I have found myself taking profits maybe too early, which I know that's never a bad thing. But for example, like today on the gap down, I closed out some puts just because I was afraid of a short squeeze. And I used the 10x bars, and I'm pretty confident in those. But lately, I just seem almost too scared to let the trade continue to work. And it seems like I'm leaving money on the table. But it's also due to the volatility and probably because I got burned a couple of times and trying to get too much out of the trade. So I'd love to hear your thoughts on that, and I appreciate it.
I have something to say on that there, Toro Joe. Glad to see you here. So as far as letting it work, I want to suggest your size for you. Don't position size huge, like just position size within your means. What I want you to try doing is first accept your risk, right? Position size to where if it goes completely against you, you are okay with it. I don't care if it's a $1 debit spread and you only buy one position. I want you to pick your setup, pick your entry, take one position where you accept the risk and ride it out till expiration. Now, why till expiration? Because it's going to teach you to hold onto that position until the end. And you're either going to be right or you're going to be wrong. At the firm I trade at, we actually don't even they preach to hold it through expiration just to get same day substitution. And then through the longer term, if you're right, then your wins versus your losses will succeed or beat your losers. So if you can learn to just accept the risk, think of it as a scratch ticket, right? And you're thinking, like for me, I have all those bearish spreads going to the end of October. For me, that bet is basically saying, I think the market's going to be lower in October. And if I accepted that risk and position sized for that risk, then it doesn't matter what happens intraday or throughout the week, as long as if by October, I'm right and we get there. So if you position size and just hold it all the way through, I think it could be a good way for you to learn to trust your process and just let it ride. But the first step would be to accept a risk and just let it work. Don't even look at it. Just let it work.
So I was going to suggest a slightly different exercise, and maybe you can listen to both and see which one makes more sense. But for me, what really made it possible for me to handle sort of managing a position for longer term is to take partial profits, right? Now, that doesn't mean you have to do it on every trade, right? And the goal is not to just carry a tiny position all the way to a big gain, right? If you put on a big position and you take the risk, you want to carry a big position to a big gain. With that said, right, when you're just getting started doing that, and it can be nerve-wracking to hold that bigger position, you can start, right, to see the benefits of holding it longer and to get experience with that by taking some off, letting the risk on the remainder run, knowing that you've paid for it already, right? And that's how you can build the experience, letting things go for longer term, right? It gets you to some of that same place that Kody was talking about making sure that the risk of what you're holding is manageable and just let it go. So in that way, it's similar, but whether or not I'm planning on holding something to expiration or not, just for that added ability, I virtually never take a trade that I can't take partial profits on.
So I would actually go in combination with David and Kody. As some of you might know, and Torjo, you might know, I've been spying an Amazon setup for a while on the monthly chart that I have slowly built a little bit of capital into. All of the contracts that I've opened, though, the expirations are within my risk tolerance. So I still keep everything within it and keep it very small. On the specific trade, I actually have a divergent bar that's helping me give a time frame where I'm looking to hold that trade through. So that kind of helps, of course, with the timing. But otherwise, it's about leaving it out there. If I see a profit that I want to take, like today, I took a little bit off Amazon to help control risk and lock some of that in. But otherwise, I've allowed myself to leave runners on to look for the proper setup to follow through. So when I do a one lot, I try and keep it out there for the actual follow through of what I'm looking for the technicals before trying to take it off. Or if it has like a really great profit target where I'm just like, that looks great, I want to lock it in here, and then I can always look to reload back in if I choose to. But first and foremost, to me, just like Kody, it's all about keeping it within the risk tolerance. So as soon as I put it out there, I have to understand that I could lose everything. And so as long as I keep that risk tolerance small, right, and within what I can do for myself, as I know what my personality type is and everything else is, it makes it easier to follow the technicals and the trading plan. And that took me a while to learn, right? And it's what helps keeping a trading journal and things like that. But the less emotion that you can take out of your trading, because there's always going to be emotion, but the less emotion and the more that you can control it, the easier it is then to follow along with the technicals. And I found for myself that emotion stems from how much risk I put out there. So if I keep my risk small, then it allows me to follow the technical, and then I can try and hold for that bigger profit if it's just a one lot, or like David said, if I have multiple contracts, I can start to shave some off along the way while still leaving those quote unquote runners on the bigger technical move I'm looking for.
One more thing hit me there, Torjo. I want to hop in really fast. Another thing that helped me learn this, and I imagine you hopped out of your, you said you hopped out of probably the alert I gave out on the SPX put spread you're talking about. Another thing that helped me when I was learning to trade was at entry, screenshot your chart, and then also in your trade journal, have a trade journal. If you don't have one, email me, I'll send you one. And then journal your entry, your setup, your target, your stop. And then so in the moment, so like today, so we entered it yesterday and today's happening, you're having a gap down, right? It's moving in your direction. You're feeling emotions. To help you maintain your sight on the target, what I did in the past was go ahead and look at my trade journal for that trade. And then it helped me keep in alignment of what the overall goal was by just looking at what I was thinking at the time no emotion was in the trade. Because in those moments you're feeling emotion. So I want to know what my clear mind was thinking at that time to help keep me in alignment for the further target. And that is it.
Yeah, thanks. Yeah, so kind of to Allison's point, like I just started to do enter actually multiple contracts now to leave that runner on. So that's definitely helped. And then I did start to do the journal. So yeah, it's just, I think it's tough because I think I mentioned to you, Kody, a while back, I got burned on a 4,000 SPX pin once when I was up 1,100%, and then I ended up giving it all back. So I think that probably has a lot to do with it. But I appreciate all the influence you guys have. So it's great.
For sure, man. Thank you.
Awesome. Well, we thank everyone for showing up. If you guys had any questions that weren't able to answer today, we do apologize, but we definitely plan on having more of these Q&A sessions, as I feel it was a really good time. I appreciate all the traders, and from everyone here at Simpler Trading, we hope you guys all have a great weekend.
Have a good weekend, guys.
And thank you all for tuning in. See y'all on Monday.